Let's start out by defining both growth and value investing as a strategy. Value investors aim to purchase stocks below their actual worth with the expectation that they will increase in value at a later date. Warren Buffett is the perfect example of a value investor. He analyzes key financial documents like the balance sheet and income statement and looks for hidden value. Growth investors, on the other hand, look to buy companies exhibiting signs of above-average growth, even if the stock might already be considered expensive. Cathie Wood of ARK Invest is a perfect example of this. While she was definitely ridiculed in the past, some of her top stock picks like Coinbase are up massively this year. As far as which strategy is best, the answer is really neither. Our analyst believes that either extreme is not the way to go, and in fact, combining the two philosophies is the best approach. That would mean being a value-oriented growth investor, or someone who aims to buy shares of companies experiencing above-average growth at a reasonable valuation. But let's explore why either extreme can be a bad idea first, starting off with the value trap scenario. First of all, any stock trading at a discount is being priced that way for a reason, normally indicating fundamental problems. This could be political reasons like Chinese or Russian stocks, for example, or it could be problems specific to the business or the industry that the company is a part of, such as obsolescence, bad management, high debt levels, and more. For example, take a look at GoPro stock, which was flagged by our analyst as a value trap. At first glance, GoPro stock seems appealing, as it's trading at a price-to-book value of 0.51. That means the market value of the company right now is roughly half the book value of their total assets, which should mean that the fair value is roughly 2 times the current share price. But what's wrong with GoPro? It's nothing company specific. Instead, it's a broader trend that has happened around them through innovation. These days, everyone has a smartphone, and most of those have really good cameras. GoPro, which sells action cameras, is trailing off into obscurity as people would rather use what they already have attached to their phone. And this isn't just a hunch either. You can see exactly what happened by taking a look at GoPro's historical revenue. From 2011 to 2015, GoPro was kicking butt and revenue growth was strong. However, from 2016 forward, revenue has been stagnant and has even declined. That's why GoPro stock is down about 95% over the last 10 years. You can see where the stock went up for a period of time in 2014 and 2015 when the revenue growth was strong. But as soon as the growth phase ended in 2016, the stock began a long and painful descent. Even over just the last year, GoPro is down about 58%, which is a perfect example of how these value traps can play out. It can certainly seem like stocks like GoPro are a great value and a buying opportunity, but this is almost always misleading as there are fundamental problems that exist. This exact scenario plays out over and over again, with another prime example being GrowGeneration. After experiencing exponential growth during the pandemic, primarily fueled by acquisitions, this hydroponics-related company fizzled out. While the M&A activity boosted their revenues and share price for a period of time, it was not sustainable in the long run. Just look at the correlation between the share price and the revenue growth and subsequent decline. Another prime example here that our analyst flagged is Peloton, the exercise bike with the tablet attached to it. During the global pandemic, when everyone was stuck at home, sales skyrocketed and the revenue growth was parabolic. As such, the stock soared, but the same scenario played out. The lockdowns were a short-term trend, and as soon as things returned to normal, the revenue growth stopped and the stock cratered. Moral of the story here is growth is not everything, and it can even lead to poor decision-making on behalf of both investors and company management. That's why our analyst urges investors to buy great businesses at reasonable prices that are expected to grow over time, and reasonable does not always mean undervalued. Value investors like Warren Buffett have spent their entire careers scraping the bottom of the barrel looking for hidden value. Most of what's undervalued is absolute trash, and once in a great while, you might find something. That's why Warren Buffett rarely buys new stocks.